if Trump is smart, he needs to pivot the conversation away from tariffs to something else. The big, beautiful bill, kind of positive, but everyone's worried about the impact on the deficit, so maybe it's not as positive as people think. I think deregulation is sort of the only real card he's got from a reputational perspective. Regulation keeps volatility dampened. Deregulation unleashes more animal spirits, more aggressiveness, and then cycles kick in terms of that being more aggressive than it otherwise would be prudent. All right, that's greed is like that. It might then create a tail event and crisis down the line, but that's the nature of free markets. You can't really see beyond the horizon. So it's like there's some point in any forecast where the further out you go in the forecast, the less likely it is to mean anything. But you can only see up to the edge of the horizon.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Well, I certainly appreciate you taking the time. The biggest thing I wanted to talk to today about is some noise that you've been making that resonates with me to a certain degree. And I don't hear a lot of people talking about it or making the bull case for it, right? Because there's so much headline around the tariffs and the big, beautiful tax bill and all this stuff, right? And even this morning, right, as we film this, there's like the headlines now on Apple getting tariffed specifically. There's the 50% tariff on EU going into effect in potentially a couple days, right? Like, which ironically, like you would expect the market to be selling off a ton, and it's seeming to catch a bid. So that hand might be overextended. But the thing that no one's really talking about, that was a theme early on, like things people were considering before all the headlines started going, was this deregulation of the US, which by comparison, my belief, and I'm not super cultured, is that by comparison, the US has been the least regulated, right? Not low regulation environment, but by comparison, not a lot of regulation. And so there's been this American exceptionalism, I think driven largely in part because of that, combined with our entrepreneurial spirit in the U.S. But if we experience more deregulation, that is what you think is a really bullish case for a set of U.S. assets.
Yeah, and actually, there's I think there's a lot of interesting implications to it. So first of all, let's unpack it very carefully. So, what is the fundamental impact of regulation? Fundamental impact of regulation is comply with regulation. Okay, well, complying with the regulations, of course, means there's costs associated with that. Now, if you're a mega cap company and you got to deal with compliance, you have the liquidity and cash flow to do so. You're a huge company, you've got free cash flow. You can easily, buff up your compliance department or whatever it is to make sure that you're adhering to whatever rules and regulations are in place for your industry, for your idiosyncratic aspects of your company. If you're a smaller or mid-sized company, you have to comply with the same regulations, but you don't have as much cash flow to deal with that, right? So it impacts your bottom line far more disproportionately than it would for larger companies. So if we go with that as a thesis, then you can argue that part of the reason why mid caps and small caps have lagged large caps outside of the AI tech dominance that we've seen is because there's been increasingly more regulation that's have been put in place, under the Biden administration, for example, and that has held back the earnings of a lot of these companies, the earnings surprise potential for a lot of these companies because they got to deal with these compliance regulations. And now, if you end up having a broader wave of deregulation, which Trump seems to be very adamant about doing, then conceivably you unlock a lot of potential margin for mid-cap, small-cap companies that now don't have to worry as much about the regulatory side of things. Further to that, deregulation, in theory, should result in more M&A activity. Deregulation, in theory, should result in more product and service innovation, more faster to market type of dynamics. And if I'm right in that thesis, then we could finally be at a multi-year inflection point forget about sort of risk on, risk off short term movements, right? We could be at a longer term cycle that's finally favors mid cap and small cap companies. Now, some people will say, well, on the small cap side, it's still going to be hard for a lot of these companies to survive with rates as high as they are, which I don't disagree with. But if the benefits from the earnings side of deregulation are enough to counter higher interest expense, then conceivably, maybe these companies are really mispriced and could actually rally quite a bit, right? Because now they're not on the cusp of death, right? From like a zombie company, ongoing concern type of dynamic. So I do believe that this is a much bigger theme than people appreciate. I'm with some partners launching an ETF early June, which will make a lot of noise about, focus on this very idea. But it is even consistent with my sort of broader belief around small caps hold the key. And if you're going to be a believer in a bull market, you need to finally see other things rally substantially faster than the S&P. And I think deregulation could ultimately be the catalyst for that.
So what I think like one of the questions sometimes is, in the US, we feel like we have this relatively low regulatory environment. Yep. And I think anyone that thinks we have a high regulatory environment really has no concept of maybe how regulated other markets are.
Right.
But like, what is there any kind of major pieces of regulation that you can point to that you say like this was really a hindrance to, small or mid caps or this sector or, theme of companies, like this really hindered them. And so if this piece of regulation gets pulled off, that could be a really great tailwind.
So the biggest one obviously is the gutting of the EPA, right, on the Environmental Protection Agency side, because the impact of that is, well, if you're an HVAC company and now you don't have to worry about emission standards being as strict as they were, well, guess what? Now you can unlock a lot more potential earnings because of that, right? Anything around permits for the energy infrastructure space, right? Making it faster to get permits in place to put pipelines in place, right? That's a big deal. So it's like you're already seeing some of the stuff at the margin. I saw just the other day, what was it? Trump is enacting, I think, some kind of wartime act around nuclear to get nuclear faster to market, which I'd argue is another form of deregulation, right? So I think you're seeing that there's a lot of potential for some interesting repricing already in terms of how those companies, like a Comfort Systems on the HVAC side, would benefit from deregulation. The other one, of course, is on the banking side. So to the extent that deregulation of the banking sector, regional banks in particular, results in a higher likelihood of more loans going out, right? That could, interestingly enough, maybe increase the velocity of money, which is a whole nother thesis, which you can argue would increase inflation, but if it actually creates more competition because now there are more competitors entering a particular industry, that could be ultimately disinflationary on prices, right? Very long term, because now you've got more competitors to compete against. But those are sort of the major ones, and there's still more to come. I mean, again, if Trump is smart, I think he needs to, and I know that question is a function of one's political viewpoint. If Trump is smart, he needs to pivot the conversation away from tariffs to something else. The big, beautiful bill, kind of positive, but everyone's worried about the impact on the deficit, so maybe it's not as positive as people think. I think deregulation is sort of the only real card he's got from a reputational perspective. And you should start to see it show up in earnings results in the coming quarters for certain companies that are obviously much closer to that, which again, based on the type of AI screening that we've developed for this new ETF, ticker is going to be FMKT. A lot of these names are mid-cap and small-cap names.
Yeah. What is it in the banking space that's prevented, regional banks from lending? No one really seems to talk about that a whole lot. I'm sure in institutional spaces for sure, but like on Main Street, or just like here locally, we've got some great local banks. I know like within regional banks, for anyone listening, especially like my local audience, like Zions Bank, Zion Bancorp, that's within the regional bank space. And they would appear like alive and well, so what is it that's been hindering them or preventing them from doing more business?
To the extent that they have higher leverage loan requirements because they're being ultra conservative because of things that have been put in place post 08, as an example. right? That would prevent them from loaning more, maybe taking on riskier types of loans, which may end up panning out just fine.
Hmm.
But most of this stuff around the regional bank side is ultimately about how much safe collateral they need to have against what they're lending, right? So if those requirements drop on that deregulation push, in theory, means that regional banks are freed up to be more aggressive. And let's face it, real gains don't come from being conservative.
What nothing ventured, nothing gained. What about like I think about the Glass-Steagall Act, right? And that getting repealed in the 90s and allowing, kind of taking the cuffs off the investment banks and allowing them to trade and get involved with that. And some people would make the case and argue that that really led to some of the run up in 08, right? With the MBS stuff, the financialization that took place, the leverage, and ultimately led to the downfall of some huge banks. So, so you have sort of a long term is like, okay, if the deregulation comes, maybe this is really bullish for regional banks, but for like a period of time, maybe, because maybe there's some great profit to be had, but on the backside of that is maybe some really irresponsibility, grows into some irresponsibility, extreme leverage. And like, what's the risk exposure there? These are the things I always think about when people say you just buy and hold forever, you go, well, maybe not forever, long time, maybe forever, that there starts to be concerns, right? With second order effects.
I think you're spot on, which goes back to the earlier point that deregulation, the impact of deregulation and freer markets should mean more volatility, right? I mean, regulation keeps volatility dampened. Deregulation unleashes more animal spirits, more aggressiveness, and then cycles kick in terms of that being more aggressive than otherwise would be prudent. All right, because greed is like that. It might then create a tail event and crisis down the line. But that's the nature of free markets.
Mm-hmm.
I mean, it's like, why is Bitcoin as volatile as it is? Because you can argue it's the one asset that perhaps has the most free market dynamic to it, right? So, again, I don't think anybody should be against that. Volatility itself creates opportunity. As much as it was painful, and a lot of people lost a lot from that. A lot of people also made a lot from that afterwards, right? It's like I always go back to, if you're a real longer-term investor, you should hope for occasional tail events, as long as you don't need the capital that you're invested in, tomorrow. You should hope for some tail events because time is on your side, right? You want to buy low. It's like, it's always better to average down than average up if your time frame is long enough. Yeah. Because then your average price is lower, right? So I think we should all be rooting for that. It's like people that think that if you're bearish, you're rooting against America. Actually, no, you're rooting for yourself and for your future self, because you're going to get lower prices today for your future self, where the price will be likely higher. Yeah.
You have any thought around the deregulation impact and the dollar and the dynamic that's happening there?
Yeah, I think currency is going to be largely driven by a lot of other things beyond deregulation. But I mean, as a thought experiment, let's think through it. So deregulation, I think, at its core, is probably going to be largely disinflationary. Okay, so if it's disinflationary, then you would think the dollar would strengthen under that, right? And if it results in more growth potential, then you might have more foreign capital going into the U.S. to benefit off of those companies that now have much more ability to be efficient because they're not having to deal with regulatory compliance. So I think the dollar probably would have an upward tailwind from that, but there's so many other complicating factors there between interest rate differentials across countries, how different countries are responding to tariffs, and if they're selling treasuries, and they're in this currency war dynamic. Yeah, I think it's nuanced, right? But I think I haven't thought about it before, but I think as I'm thinking about it now, I think it's probably largely a tailwind for an appreciating currency.
The weird thought experiment I'm always kind of cycling through my head and running these mental models on is almost the three-legged stool right now of U.S. equities, the dollar, and interest rates or yields, right? And so you would think if the dollar appreciates, that typically is correlated with yields rising. Yep. But a deflationary environment is correlated with yields, lowering yields or dropping yields, right? So, if deflation is good for strengthening the dollar, it sort of breaks the mental model a little bit, right? It breaks the model.
I guess it depends on which side of the duration we're talking about then, right? So typically when the dollar is appreciating under disinflation, longer duration yields would fall, right, under that scenario, as opposed to what we've seen, which is much more, a lot more focused on the shorter end of the curve. That though could be challenged because of all the deficit issues, right? And as much as I want to see treasuries act as a flight to safety trade, I'm on the same page as everybody else in the world. It's like this debt is unsustainable, and yields probably need to force discipline to stop the spending, or at least abate it somewhat. There's a difference between being bullish on treasuries and then being bullish on treasuries for trade, right?
Yeah.
But in the context of that, I think then it just becomes a question of, well, how does the duration side of that impact the whole thesis? And I don't know.
I don't know.
Right. Yeah, it's
there's people way smarter than me with trading duration.
Yeah, well, and I'm clearly not one of them. I mean, I design my own existing strategies to play long duration when they're risk off, and it's been a brutal cycle because credit spreads haven't widened.
Yeah. Let me ask
by the way, real quick, I will say if the deregulation thesis is right, then you should be in a cycle where credit spreads do stay tight, which goes back to one way to resolve the disconnect between small caps and credit spread. The small caps rally and outperform because they're betting that investors are betting they're not going to go bankrupt, in which case they should reprice higher because now you've taken out the default risk, which deregulation should be a.
So you're saying, so in essence, you're saying that the tight credit spreads would have been leading.
You know, the
validation or the confirmation would be small caps actually rallying to validate those tight spreads.
Right. And that's been the big disconnect. So there's two ways to resolve that. One is a credit event where spreads blow out, which was always my original thesis with Japan and all this. The other way to resolve it would be if deregulation really does kick in, benefits small mid-cap companies, in which case they do rally, in which case credit was right all along. It's just you needed deregulation to be the sort of wake-up call for the small mid-cap space to take out those default risk concerns that have held them back for so long.
Yeah, I think so many people forget that small caps and mid caps to an extent they've gone years without making a return, total return.
I keep hitting it all the time. It's like people don't get it. It's like people say I'm a perma bear. It's like, well, what perma bear? I mean, small caps are basically halfway through a lost decade. They've gone nowhere since 2021. In the depths of the tariff, they went back to 2020 levels, late 2020 levels on the Russell 2000.
Yeah.
And by definition, there are many more small cap names than large cap names. It's the Russell 2000 against the S&P 500.
Yeah.
So there's this really fascinating disconnect where people view the market as just passive S&P because that's what the media tells them, in quotes, the market is. No, the market is all stocks.
How do you square the whole deregulation thing against the systematic, passive flows supporting the S&P and kind of the big momentum trade there? I know Mike Green and kind of his work. Yeah. How does that square? Do you think the deregulation lends to an outperformance for a period of time? But then sort of burns out because everything reverts back to the systematic passive flows. And if the deregulation doesn't push small and mid caps large enough that they gain more market share in target date funds, that they don't get the sustaining flows to keep them elevated.
Yeah, I love this thought experiment because I think the answer is it remains to be seen. So because I don't disagree, right? There you do have this. I've called it systematic insanity. You have the systematic bid, right, on the large cap 401k side of things, right? That just keeps large caps going the way they're going. So who cares about undervalued stocks if almost all the flows are just going into this set weighting passive vehicle? I guess my response to that would be, I don't know. I still believe that markets are going to beat markets and that people will see that valuations are less expensive and that some of these companies are growing. And to your point, maybe they'll grow fast enough that they now actually would benefit from those passive flows. They graduate to that large cap side of things, right? In which case it becomes even more self-fulfilling. So we'll see. I don't know. It's this is sort of the great question mark for any asset allocator. It's like, are you ever going to be in a cycle where things beat the S&P ever again because of this auto bid? Right? Your guess is as good as mine.
Yeah, I don't. Well, that's a hard thing. I explain this to a lot of clients, a lot of people. It's like it's going to end at some point, right? But I don't know if it's going to end 2 weeks from now on, some major economic blow up and everyone loses their job, and that's what causes the change in flows, or if it goes for another 3, 4, 5 decades. I have no idea, right? And so it's one of those things. You can hate the game. You can absolutely hate the game. You are entitled to that. But we are all going to play the game either way, right? And so you can play to win, or you can, complain and sit on the sidelines and lose by default. And I'm not interested in losing. I want to play to win. I want my clients to win. And, in iterations or innings or periods, right? You win some, you lose some. But overall, it is a winnable game. And what I've kind of come to learn is, if you have the intestinal fortitude for it, it's become a more winnable game. But it also becomes a riskier game when it does unwind.
Sure.
Right.
Sure.
So
yeah, because everyone's in the same trade at that point. Everybody's in the same passive S&P 500. Concentration risk becomes very high, like we've been seeing. Right. And it's like if everybody's same side of the boat, that's a contrarian risk.
Right. But if you have a structural passive bid, and you just use leverage, you can, right? You can outperform. The question is, when you have a 30% drawdown, is that it, or is that the dip to buy?
Right.
And you have to be able to try to navigate that, because at some point, the dip is not to be bought, right? At some point it will come unwound. And I think the biggest threat to the whole thing is always, at this point, going to be just the nature of the flows. I think Mike's really onto something unique there, but the same thesis that he has that says, like, you're going to have the supportive effect in the S&P also lends to, in my opinion, that inelasticity of things that aren't in the S&P, right? That like small and mid cap, plays that have been beaten down because of regulation. And so when those take off, that inelasticity, because there's not the fund flow to it, and now all of a sudden there's a rush of money, it could get, it could take off, right? It could have a meaningful impact on a portfolio. And as momentum picks up, momentum is self-reinforcing. And so there could be a sustained rally in that stuff. The question is just, on a multi-year rally, how long can long can it last? And can it last through the next political cycle where, the next administration comes in and then it starts to enforce regulation once again, or not? It becomes long-term and interesting. And no one knows, but
no one knows. But it's like you play with, you can only see up to the edge of the horizon.
Yeah.
Right. You can't really see beyond the horizon. So it's like there's some point in any forecast where the further out you go in the forecast, the less likely it is to mean anything, because many more random variables, butterflies flapping their wings, impact the end result, and how the horizon then looks, right? The further you go down the line. So, but to your point, it's like you don't choose the cards you dealt, you choose to play the game. In my world as a product developer, from a fund manager perspective, I don't want to be in a world where it's only about the S&P, because nothing closes a sale like a chart, right? When it comes to getting assets in a particular fund or product that you're developing. Sure. And the issue as a product, which is, by the way, an issue not just for me, but all issuers, is if you're not able to beat the S&P, nobody's really interested in your products, right? And that's largely cycle driven.
Yeah, you got to beat it on return. You got to beat it on risk. One of the two.
Yeah, well, right, exactly. But at the same time, it's like, all right, well, if you're in a cycle like that, what, you're going to try to come out with an S&P 500 product at a 1 basis point fee for a $250K a year expense to just keep an ETF open? Of course not. Like, you have to offer something that's different, so that in the event that the cycle does favor whatever your strategy is trying to take advantage of, it really works, and then you can really get some inflows because now the chart's favoring your approach because the cycle is allowing you to, right? So
Yeah.
everybody in the fund world hates this environment, right? Because everyone's competing against the same ETF, SPY, QQQ. That's it.
Yeah, there's an interesting thing that I've noticed that I call it, it's the tracking error that has led to closet indexing.
Right.
So there's this notion that active managers underperform. Well, because active managers are just trying to they're just trying to stay tight to the S&P, right? Just a couple basis points better on the up or a couple basis points better on the down, and then they just kind of say, well, the market is going up or the market's going down, and clients have that expectation that it's going in that direction. And what's kind of sad about it is it's really degraded, I think, a lot of actual intellectual.
Oh, there's no intellectual
capital.
It's of course not. It's all just that's exactly right.
It's just, can I do a little bit better or a little bit tiny worse, and just be marginally better. But I'll have this most, like career safety in that idea, or business safety if you're, for some of these people that launch these huge mutual funds or have these big mutual funds. I kind of hate that about the industry.
Oh, it's this is not a good way to say it, but I think it's the only way to say it. The reality is the dumber one is, the better they've done in this kind of environment, right? Because don't think, just go into SPY and who cares about anything else?
Yeah. Well, if you pull back the hood a little bit, it does make a reinforcing point for, like, why would you buy, in my opinion, a fund, and I don't want to call anyone out by name, but it would be so obvious to look at these stuff. But you look at something where the fee on the fund is a little bit higher, not outrageous, but it's a little higher, and it's like tracking error to the, it's a beta of 0.99 to the S&P. It has the same drawdowns at the same time, and it's got a similar upside capture. And you look at it and just go, you're a closet indexer.
Yeah.
It's there's one that's out there, and I joke. They said, well, we're not like the S&P 500. We have this whole process and blah, blah, blah. And there's all these, sub teams on our portfolio management, and they do all this stuff. And I'm like, you guys are the S&P like 396 is all you are. Like it's the same thing. It's like if you get almost the entirely exact same result with just owning S&P, then just own S&P, but
it makes sense though, right? Because again, these issuers have not been able to create products that beat the S&P to raise assets because the cycle has been so overwhelming in favor of the S&P and passive. So what do? They come up with a product that sounds like something that's different. It basically has S&P like performance with slightly higher fees, right? or even quite a bit higher fee, and then that's the only thing they can do, right? So like I kind of get it, living in that world as, again, a product developer.
On the equity side, I think that's the case. I will say though, like in fixed income,
there's differences.
And bonds, definitely some big differences there. And then in the alternative space, definitely some huge differences in the alternatives. When you start thinking of particularly liquid alts, which I'm glad is a growing space because I think there's some really great opportunity for non-correlated exposure.
Yeah. And that will matter because maybe I'm just hopeless in my thoughts that cycles still are a thing. But there's going to be a point where those areas should be beneficiaries of equities not doing what everyone is used to them doing, or at least the S&P and the Nasdaq not doing what everyone's used to them doing, which is maybe go sideways or go down and not always have a buy the dip opportunity.
Yeah, I don't know. I think I'm still absolutely bullish on the U.S. long term.
As am I.
And I'm excited about the deregulation conversation. I think the deregulation really could lead to a meaningful boost in productivity in the U.S., which I think could, and this is just my total personal opinion here, is it could lead to potentially a large cultural shift, right? Particularly in the middle class, which I think is what a lot of people voted for when they voted for Trump. And so, not to get into the political conversation at all, but I just think that that's what, in general, what people voted for, right? And the deregulation, I think people dismiss how much that could be a positive effect, right?
Yeah, and I think I to your point, I think it's kind of maybe a good place to wrap up the conversation. But I think one of the things you can argue, which has torn the fabric of society somewhat apart, not to be overly dramatic with it, but it's this belief that the odds are stacked against the little guy. Right? It's like who benefited the most coming out of COVID? All the large players, while all the restaurants that were shut down never were able to come back.
Yeah.
Right? And a lot of small businesses that have not. I've done polls on this on X on my @lead lag report handle. I've asked like how many of you small business owners have seen growth are better now than you were in 2021, 2022, or even before that. And most say they're not, while other big companies are thriving, which is what you're seeing with the small cap, large cap disconnect. Right. So it creates this acrimonious feeling of like, the system is against me. Okay, well, maybe deregulation counters that and actually creates some hope and some entrepreneurial spirit, because now it's like, now you're kind of leveling the playing field. That's the thing. People think regulation levels the playing field. It actually doesn't.
Yeah.
Because costs being borne by the smaller businesses as a percentage of their earnings are higher than larger companies, right? Yeah. So this is why, I think it's a much bigger deal. And I think, I think to your point, it's an interesting thought experiment too. I think it could be very beneficial for just society, for the psyche of the American entrepreneur.
Yeah. Yeah. I think U.S. exceptionalism will live on. I know international has been outperforming this year, but I think if you look historically, that tends to last for weeks, months, quarters at most, and then it reverts back. I think the unwind, like that capital, if you have a strengthening dollar, that capital unwind that fled the U.S. The irony of it is they're going to have to come back and buy at a higher price on the S&P, a higher price on the market, and potentially a stronger dollar than where they sold. So that will be those flows coming back into the U.S. I believe also would be just a huge tailwind for asset prices. But
I agree. We'll see. We'll do a follow up on it in a few months.
Yeah, we'll see. Cool. Well, hey, appreciate you hopping on. It's always fun talking with you.
Yeah, no, I appreciate it, man. Keep doing good work. I know you're among the good advisors out there that's trying to think differently about the way the world works.
Yeah, a little bit of thought sometimes goes a long way.
A little bit, just a little bit, few.
So, all right. Hey, we'll see you around. Take care.